Good day. This is the continuation of financial statements analysis or analysis of financial statements as well as the cash flows. The first stop would be, of course, financial statements analysis continuation and also to the cash flow analysis. And the first part will be talking about the cash flow items or analysis. Anyway, on the screen, this is coming from the CFI, so corporatefinance.institute.com. This is not my picture, but you can just see here that in financial analysis, we're going to look into the financial statements and we will be doing a lot of analysis. Could be, for example, would be the trend and ratio, pyramid ratio, basic ratio, and using ratio analysis. So a lot of analysis that we can do on the financial statements. Now, before I proceed to the discussions, allow me to mention that if you say financial statement analysis is not just a matter of what percent that the ratio increased or what percent that it decreased, or in terms of the formulas like what percent that, for example, the numerator or denominator increased or decreased or remained constant. It's not just that. That's okay, that's correct. But in addition to that, financial statement analysis is very deep on the sense that you will have to ask yourselves what caused those increase or increases or decreases. So what caused them? For example, if you say the ratio increased, so is it a matter that was found on, for example, income statement? And then let us also take note that the financial statements are interrelated or interconnected with each other, such that item on the income statement or statement of comprehensive income, including the OCI, of course, section, could be very connected with the other items found in the financial statement. So that's the concept of articulation in the conceptual framework. So in that, there could be a lot of things, not just the percentages. We have to explain what caused those changes or effects that happened along the way. All right, so to continue, anyway, this is the discussion of free cash flow. So if you say free cash flow, we have to, of course, compute first operating cash flow. And to do that, that would be earnings before interest and taxes. We call this EBIT. So earnings, this is basically the net earnings. So this is our gross profit, so sales minus cost of sales. Then we deduct our operating expenses to get operating profit. We add our other income to get the total income or our total earnings. And then this is though prior to the deduction of interest and taxes. So we call this the pre-tax income, then minus taxes, and we add depreciation. So we can notice that this is before interest, but we did not deduct interest yet, right? Or we did not deduct actually our interest, on the sense that interest actually is a finance cost or item. So it's not part of the operations of the business. Interest here is in relation to the loans made by the business. So that's a financing aspect, or let's just say getting the money or resources for the business. However, there could be some, let's just say, differences in terms of interpretations on other items of the statement of cash flows as well as the analysis. Anyway, interest as paid can, of course, be presented under operating, and then for some, financing as an alternative or option. But initially, that's going to be under operating. So say there could be some differences there. However, this is on the case of computing operating cash flow under free cash flow. So we just have to respect the source and the computations. Then minus taxes plus depreciation. Depreciation being a non-cash expense. If there is, for example, a non-cash income or revenue, then we are going to deduct, as explained, of course, under statement of cash flow analysis. Okay, So free cash flow then is equal to whatever is the operating cash flow. We deduct the change in gross fixed assets, so the non-current assets, minus the change in current assets. So basically we can say if we combine these two, so changes in assets, we can say that. So this is actually the opposite of what we have said under the statement of cash flows computation, especially if we compute from accrual basis to cash basis. So remember, we said that anything that increases the equity, if there would be an increase of an asset or increase of any components of assets or the total, then that would increase also the equity. That's the direct relationship between our assets and equity. By then, should we convert from accrual to cash? So we are going to do the opposite, which means that we are going to deduct the changes in assets. Then for the liabilities, assets being constant, liabilities have indirect or inverse relationship with our equity. And so when there would be increases of the liabilities, so we are going to add that back. Then of course, if there would be increases, remember equity would decrease, right? So that would be a minus supposedly to equity, but we are going to add that back to have impact on the change. Anyway, that's how we analyze it basing on the basic accounting equation. But if you are going to treat it this way, which is also a good analysis or other way of analyzing it, if we say the changes in assets, then that would mean, for example, increase of the assets. This would mean that we purchased more assets. So if there would be an increase, meaning if we talk of cash flow, that would mean disbursement. So we are going to deduct. On the other hand, if we say increases of the liabilities, so this means that we paid less of the liabilities. That's why it's going to be an addition. So meaning it could be an inflow then. So meaning increase of liabilities. So we made more loans. We did not pay our liabilities soon or immediately. So that's an inflow to be considered. All right. So these are the points under free cash flow then. Hopefully those items are clear. Next would be here an illustration or summary of inflows and outflows. If you can notice again, the decrease in the asset means that we did not acquire more assets, or let's say we sold assets, so that's why it would be an inflow. Outflow here, increase in any asset, so meaning we purchased more asset. Increase in liability, so meaning we borrowed money, inflow. Decrease in liability, so we paid, liability, outflow. For net income profit after tax, that would be a plus, that's an inflow. Actually, to move from our accrual to cash. So this would be a source of an income that is not yet really cash. So that's why we have to make some adjustments. The net loss would be, of course, an outflow or minus. Depreciation should be added back. Dividends paid would be the outflow. Then sale, clearly when you sell shares or stocks, whether ordinary, also known as common or preference or preferred, so there would be an inflow, an influx or plus of money. While if we repurchase or retire the stock, so that would be a minus or outflow. All right. So here is a sample statement of cash flows for Global Petroleum Corporation. So we have here operating activities, investment, and financing. So these are the three activities that we can think of business or corporation or entity. So we've said it already that it is provided by if operating, then used in the book here or source use consumed. So it's also okay. But for Valix, for example, he is using the term used in instead of provided by. And then for operating, again, this would be the changes in working capital and make some adjustments. We call this indirect method By the way, if I haven't mentioned, because we started from accrual net income to become cash, we can also compute this cash flow using the T account. So all items that have impact to cash can be segregated into operating, investing, investment here, but it is investing to be consistent, and financing. Investment is okay though. And then changes in working capital, both current assets and liabilities, including the net income and the other adjustments. Investments would be the fixed assets or non-current assets, and financing would be the liabilities and equity. All right. So to get the net change or increase or decrease of the cash flows, so allow me to show this in a smaller version. Then the net increase in cash and marketable securities, because the pluses are greater than the minuses. And with that, it's not shown here though, but if we add this to the beginning balance, whatever that is, then we are going to get the ending balance of the cash flows. So if there's no detail like showing the beginning balance prior, it seemed that this is the first year, which I suppose is not the case. But then it should have been shown here at the bottom. Add cash and cash equivalents balance, or cash and marketable securities balance beginning equals the ending balance of cash and marketable securities. So also a warning though, or a caveat of marketable securities, because marketable securities actually, not all of them will be treated as near cash, like cash equivalents. Because for them to qualify as cash equivalents, then they should be having like date of purchase, and they can be available within 3 months, 90 days for the banking, so 90 banking days and lesser. So if marketable securities have purchase dates, or let's say availability of 6 months, and then more than 3 months, so more than 3 months to 6 months, that will be treated under short-term investments or short-term marketable securities, which are no longer cash. So that's why I've said a warning though, that the marketable securities being mentioned here are the cash equivalents that we have known of under IFRSs. Hopefully that is clear. Next, analyzing financial performance using ratio analysis. So depending on the source or book, there can be a lot of groupings or classifications of the ratios, but these could be the common ones. Liquidity, which means about the ability of the company to pay or satisfy short-term or currently maturing obligations as they come due. Then activity is the speed, so how fast a firm converts various accounts into sales or cash. So this is operational. Debt ratios would be the proportion of the assets financed by the firm's creditors. So the claims of the creditors would be what percent of total assets, as explained by me in the first session of this particular series for financial statement analysis on that basic accounting equation model under statement of financial position. Then profitability ratios would be the firm's earnings to its sales, assets, or equity. So whether the activities resulted to profit or losses. All right, but we want profits, of course, because this is business. Then we also have the market ratios, relate a firm's market value to certain, I cannot do it, certain accounting values. Okay, next. For the usage of financial ratios, we have here the benchmarks. So if you say benchmarks, we are talking here about our standards or targets or quotas. So in the first benchmark, we compare the current year's ratios with the previous year's ratios. So this is called intra-comparability or intra-comparison. So what's the point? We want to identify the trend, so our trend, our own trend of our own performances or position, cash flows, etc., our ratios, changes in equity, to identify trends that help them evaluate the firm's prospects. While the benchmark two will be we have to complete our ratios to compare to other firms in the same industry. So take note, the comparison done is apple to apple. Why did I say that? Because for first one, we compare our own ratios with the previous years. So same ratios, that's apple to apple. Of course, we cannot compare one ratio to another ratio. That's apple versus orange, and that's useless. While benchmark two is that the ratio of one company is compared to another company in the same industry. So that's what we can do also here. And here are the ratios that we can make use of in our analysis. One of that is current ratio. So that's current assets over current liabilities. We also call this one as banker's ratio. So this is called a banker's ratio because a lot of bank executives and finance personnel would be using this particular ratio to be able to assess the standing or financial standing of a certain business or entity. So example of that would be, let's say you're applying for a loan. So the bank would be looking at your financial statements as a business, then dividing that. So the desired one is of course greater than one. Some would said, or some would say that the current ratio that is desired is at least 2.0. So meaning it's twice of the current liabilities. On the other hand, a quick ratio is basically focused on the quick assets. So quick assets would be current assets minus inventory and prepaid expenses and non-current assets held for sale. So current assets here are those items that can really be available to cash as immediate as possible. So the cash and cash equivalents, the short-term marketable securities, and the accounts receivable, which these items can be, of course, available within banking days and can be collected, of course, within the banking days. So that's why if we talk about inventories, prepaid expenses, non-current assets held for sale, these current assets are excluded to get quick assets and divided by current liabilities. So we expect though that quick ratio would be less than the current ratio, all right, with the same current liabilities. The numerator here is greater than this one. Then quick ratio is also known as asset test ratio. So asset test because it measures like how fast a certain entity can make use of quick assets to pay obligations. All right. Those are the two, but there could be more, most common. The ratios presented here are the most common ones. So we have the activity ratios that would check on the speed or how fast a certain entity can sell the goods and pay the liabilities, for example. So example, for inventory turnover, this measures like how fast it is that an entity can convert inventory into sales. So inventory is partnered with cost of goods sold. In fact, the inventory here would be average. So balance sheet items would be average. So 2 years, this year and the prior divided by 2. Then average collection period is accounts receivable total, and this is going to be average, and this is net of the allowances. So we can say this is the net realizable value of accounts receivable, average, divided by the average sales per day. But if this is like for that year only, so anyway, we will have to use 1 year. So average sales per day is the total sales for that year. And this sales here is credit sales that is net. So average net credit sales per day is the net credit sales divided by 360 days for our business year composed of 360 days. Although for finance books, they are using 365 days. So for us, we will be using 360 unless it is stated in the problem to use 365 days. Then average payment period is accounts payable. This is average. Then purchases would be net credit on account purchases to be partnered with accounts payable, similar to accounts receivable. And this is the net credit purchases divided by 360 days or 365 depending on the given in the problem. But if the problem is silent again, use 360 days. Then fixed asset turnover is sales. This is, of course, the total sales, and then how fast can we make use of the fixed assets to generate sales. This is the fixed asset turnover. All right. And total asset turnover is from fixed asset turnover, same numerator, we just have to change that to total assets. All right, so these are the most common activity ratios. Another set would be the debt ratio. So for the debt ratios, in relation to the liabilities and the assets. So first is debt ratio. We have the total liabilities or debt over total assets. So we will get like what percent constitute the liabilities for the company. Next is assets to equity. So we can see like what percent or at how many times total assets is to the common stock or the ordinary shareholders equity. Although I understand that the equity here could be also the total shareholders equity, which is the one that we will be using unless it is stated also in the problem to use common stock equity or unless that is available. Well, debt to equity ratio is long-term debt over the stockholders equity times interest earned or TI actually ratio is EBIT. So earnings before interest and taxes divided by interest expense. So EBIT, or that is our pre-tax income, and then we divide that to interest expense. So this is like how many times our EBIT is greater than the interest expense that we have to pay. That's also a good ratio. Another group or set would be the profitability ratios. Gross profit margin is the one that we have known. So gross profit over sales, this is really based on sales. If we use the denominator as cost, this is based on cost. Operating profit margin, operating profit again is our total income from operations less the operating expenses. And this does not include yet the other income sources. While net profit margin is earnings available for common stockholders. So from our earnings after taxes, we deduct our dividends declared for the preference shareholders so that we will get the earnings available for ordinary shareholders or common stockholders, and we divide that with sales. But then if no available item for this one, normally we just use our profit, which is already after tax, of course. Then earnings per share is really the earnings available for ordinary shareholders divided by the number of shares of ordinary shares outstanding. So we do not include preference shares because earnings per share is computed only for ordinary shares. All right. Then continuation, so profitability, normally there are ratios that would show return. So when there's the word return, we think of profitability. So return on total assets could be this, or actually we can make use of the profit divided by total assets or the net income. And the return on common equity, of course, is our profit there that is already after tax divided by the ordinary shareholders equity. So that is total shareholders equity, then excluding items related to preference shareholders. So the shares issued to them and then the share premium from preference shareholders. Also, there is the so-called DuPont system of analysis wherein do, which means dual, although we can make use of 3 or more ratios wherein by multiplying or simplifying 2 or more ratios, we can get one ratio to compute a certain ratio, of course. So Example, to get the return on asset, which is actually a numerator of profit, it is a return, so profit over the denominator assets, so total assets, we can compute that by multiplying net profit margin by total asset turnover. So remember, sales here are common items, so we can cancel so that these would be the remaining items. So that is DuPont system. Then this is return on equity. So we have here return on assets multiplied by the asset over equity ratio. And we can cancel this one. So that's why we can also get this particular ratio. So return on equity for some though could be profit over the total equity. So this is to be used unless we can determine the earnings available for common shareholders and the common stock equity. If very simple, like the problem is just straightforward, we have, let's say, the profit and we also have the shareholders equity, then we have to use that immediately. And then these are the last groups of ratios. So we have market in relation to market, and we can see that the market values are here. If you say price over earnings or PE, which is a lot of occasions or times that this is really asked in the problem, that is really the market price per share of common stock over the earnings per share for the common stock. Of course, common stock or ordinary share would have the earnings per share. So this is really applicable to ordinary shares. The book value is also applicable to preference, but then let's just make use of the common stock or ordinary shares equity. But then again, we can also compute for the preference. This is common stock equity or ordinary shareholders equity divided by the number of shares outstanding for the ordinary shares. To become outstanding, then they should be in the hands of investors or shareholders, not in the hands of the corporation. If they're in the hands of the corporation, then they would become treasury shares in which they are not outstanding. Even the shares which are still subscribed, meaning not yet fully paid, they are treated as outstanding. However, the dividends are not given yet. They will be given upon full payment. Other one is market or book or M over B ratio. So clearly that's market value or price for every ordinary share divided by the book value per ordinary share. Okay, so for some books, there are still more. We can actually make use of them also and research about them. Here, for this particular part here, corporate taxes could represent a significant cash outflow because we'll have to pay taxes anyway, and this could be used in our analysis. So example would be in computing the earnings after taxes, so that would be our profit or loss, and so on. So it would represent a significant cash outflow. The taxation for corporate income could be progressive tax rate schedule, so based on increasing rate. In the Philippines, though, we use a proportional rate in which that is at 30% of the corporate income, although there is also MCIT, minimum corporate income tax, but that is 2% of gross profit or income. So that's why it is also shown anyway. Average tax rate is tax divided by the pre-tax income. And then more relevant for financial decision making, the marginal tax rate. So meaning the additional rate, 30% before, and for example, it changed to another rate. So the point is that the rates could have impact on our analysis because income taxes will have to be paid and will form part of our cash outflow. And it will depend upon the country as to the taxation that is available. Then capital gains also will be taxed as well, depending on the existing tax laws. In the Philippines, well, the capital gains will be subdivided into ordinary, or if let's say they are really capital gains on the assets, so or capital assets. So if they are just part of the normal operations of the business, so they are treated as ordinary gains, which are of course part of the ordinary income, so the profit or loss computation. and will be taxed using the existing rate for corporations at 30% again, for example, in the Philippines. However, for the capital gains, there are also separate rulings for this one depending on the type of asset that actually gained value along the way or values along the way. And that will be discussed in taxation subject that is beyond the scope here. So to summarize, here are the items discussed. So we have the financial statements, BS and IS. Then we made cash flow analysis, and here are the ratios that we have tackled. So liquidity, activity, debt, profitability, and market. All right. So thank you very much for listening. Hopefully you learned something from this session, and I'll see you next time for another learning sessions for this particular subject, that is management advisory services part 2 or managerial accounting part 2. Thank you very much.